Hi, hi. Let's look into some specific situations where uh, during the process of valuation you may come across firms with temporary problems like strikes, litigations, warranty claims, firms with longer term problems like poor strategic decisions, cyclical firms, investment in other firms that's going to happen or has taken place, or unutilized and undervalued assets, like there are a lot of real estate on books and situations like this. So these are specific situations which is very specific to a particular organization, and these specific aspects has to be taken in the context of building the forecasted model, as because if that is not really been taken into the numbers in terms of the consequence of those decisions, or the aspects which seems to be really taking a toll in terms of some project decisions, or say some business decisions, or some financial decisions, or maybe an HR decision. So this is just to list a few. There may be umpty number of such special situations. The objective of discussing on this is to make you understand that this set of special situations has to be accounted for when you are coming up with this valuation exercise. Now let's look into uh, uh, in case of a firm which is having a negative earning, right? So when we say that a company may be getting into some sort of a negative earning, it may be on account of strike or other reasons, or it may some nature of product has sales which is of cyclical in nature, like in certain off season period, the extent of sales that actually happen is none. So that has a tremendous effect on in terms of the earning. So uh, there may be some long-term strategic and operational issues which is there at the back end. So that this set of situations may lead to a negative earning for the company. Now, in those set of situations, one has to assess whether the problem is a temporary problem or it's a long-term problem. So if it's a temporary problem, it may be like firm specific. So user prior earnings for estimation of cash flows and ROC. So the prior earnings that has taken place has to be really taken into account while you're forecasting for cash flows and return on capital employed. So if it's cyclical, then percentage revenue method and has to be taken into account, and the adjustment on account of abnormal periods has to be done, because this set of situations may be for a temporary period, and it need not necessarily be taken forward in the forecasted period. It has to be only accounted for that number of months or days when this situation is going to be in. So we need to take into account the period before that, where things were more seamless, and that perspective has to be built in the forecast going forward. And suppose if it's sector wide, then adjust growth rate to reflect cyclical changes, and value has to be normalized versus the earnings rather than current earnings. So what it essentially means is that you have to have a sector wide perspective around things, and you have to adjust the growth rate to reflect the cyclical changes on one side, but on the other end you shall also normalize the earnings basis the present earnings and the expected growth rate that seems to be a probable growth rate in the days to come, which is definitely a reflection of the past performances. Now, if it is in case of long term, if it's a long term problem, will it overcome the negative earning phase or not? So that remains a very important question. So if it is, we need to assess whether this sort of a problem is going to be existing only for a specific period, or it's going to be a sustaining one. And the aspects that needs to be really thought about in case of a long-term perspective are like the size of the firm, nature of inefficiency, the external constraints, management quality. All these aspects has to be really looked into, interpreted in a correct manner, and this is where the art part of the valuation exercise comes into play, and those has to be accounted into numbers to get to handle this situation in a better manner. Now let us look into situations where the firm is offer where valuation exercise is been undertaken for a startup where you do not really have a historic perspective to look into. So over here we see that the fundamental concepts of valuations do not change. However, it's not restricted to historical and comparables. Historical financial statements do not correspond to expected growth in assets, and value not proportional to current profitability. So these are the typical scenarios in case of a startup. Uh, uh, so bulk of the value is derived from future profitability and intangibles. So the entire profitability or the assessment that has to be done has to be from a forecasted period. There is nothing much that you can really bring forward from the historical perspective, or you may not have some comparable benchmarks to refer to, right? And so there is no historical financial statement where you may fall back to assess the expected growth in the assets and stuff like that. So what are the major features in case of valuation of startup? Non-existent low or negative income in the initial period, no operational history, no comparables, and value is fully future potential growth oriented, right? So when a venture capitalist valuation is done, so earnings are estimated up to future period when company is expected to go public. So this is very critical. So over here the entire assessment that is done is basis the earning which is estimated up to future period when company is expected to go public, right? So that's the I should say the discrete period for which this assessment is done. Earnings multiple of comparables used then at the terminal period. So at that period when suppose the company is going to get into the public mode, at that point of time some reference point we may take up in case of some comparable figures, right, when they would be able to reach a certain level of numbers. Then the discounted terminal value is equal to estimated exit value by 1 plus targeted return to the power n. So this is the discounted terminal value figure that one has to take. So at that point of time the estimated exit value, so essentially the venture capitalists would ideally like to exit at that point of time. So what's the value, exit value that the essentially the venture capitalists would be looking for is something that has to be assessed, and that gets to be a major figure for the calculation of the terminal value. And the target return normally fairly high, so obviously for a venture capitalist figure perspective they would be looking for a very high target return, and as because they're into the high risk high return sort of phenomena, right? So these are the aspects which has to be taken into account when one is valuing startups. So the general framework stands as like one has to assess firm's current standing, one has to estimate the revenue growth rate, estimate sustainable margins, estimate reinvestment rate, estimate risk parameters, and estimate the value of the firm. So this is more or less the set of aspects which I thought to place across to give you a better perspective as to how valuation is done in case of a startup, and what are the intuitive aspects that one has to really look into, right? So we'll be discussing the other sections in the next video.